All right, we've already gone through straight line and activity or units of production methods. So here's another one. It's called double declining balance method. This is an accelerated method in that the amount of the expense is very high in the early years of the life of the asset, and then it gets less as the years go on. So the way you calculate double declining balance is, if you recall, when doing straight line, there's basically what they call a straight line rate. So in the example with this whale that we've been using, the 630,000 whale, we had our management estimated that it will last for 10 years. So the straight line rate basically is 1/10. In other words, you're going to expense 1/10 of the depreciable base. So in double declining balance, you're going to double that rate and then multiply it by, and here you got to watch out, it's your book value. Your book value is not like in the other methods, your cost minus salvage value. It's your cost minus accumulated depreciation. It's this right here. Okay, so let's go through. With 2001, the whale, again, it's going to be used for 10 years. So to double that rate of 1/10, you'd go 2/10. Then you multiply it by its book value. Well, in its first year, its book value is 630,000 because we don't have any accumulated depreciation since we just bought the asset this year. So that comes out to be $126,000. So the entry is you debit depreciation expense for 126,000 and then credit accumulated depreciation for 126,000. On your balance sheet, your whale net of accumulated depreciation, or your book value, will be 504,000. So if you look back at the straight line amount, it was a lot. The book value was much higher because we only expensed 62,000 in the first year. So you can see that's much greater. It's the accelerated effect of the double declining balance. All right, now going into year 2, you use the same rate. It's still the 2/10. You don't go 2/9, you go 2/10, multiply. Now your book value is the 504. It's your cost of 630 minus your accumulated depreciation, and that will get you $100,800. So we'll debit depreciation expense for 100,800, and we'll credit accumulated depreciation for that 100,800. Now the balance in your accumulated depreciation, because remember, accumulated depreciation is a contra asset credit balance here. It starts with 126, and when you credit it for the same amount as your expense, the balance will accumulate and now be 226,800. And then our book value is going to be 403,200. Now what's different about this method is salvage value is not built into it like it was for the other two. So what happens is when you get to the later years of the life of the asset, you've got to be careful that you don't depreciate your asset below the salvage value. So our whale, we expected to sell for 10,000, so you don't want to depreciate it below 600. You want your book value to not go below 10,000. So accumulated depreciation can't be more than 620,000. Well, you can go along and keep calculating year after year, but in the final years, the book value of the whale, since it can't go below 10,000, you got to plug the amount, and it might even be zero. You might have already depreciated it fully. So what you basically are going to have to do is just make sure that the amount that you expense in the last years, it does not bring your accumulated depreciation balance to more than 620,000, which is the same as saying that it won't make your book value go below 10,000. And that's double declining balance.